So let's just look ahead to that CPI number right now, if you don't mind. We just showed the estimates. Estimates for almost 8.5% inflation over the last year. How do you see that impacting the markets as we look ahead?
You know, just as far as just today, Frank, I mean, everyone knows that we're going to have a high print, so I wouldn't be surprised if we actually rally off of that. But the bigger picture to us is that inflation remains a problem, and it's going to be a challenge for the Fed to tame inflation at the same time of not hurting the economy. So we think it's going to be somewhat of a challenge for them to stick a soft landing without breaking an ankle or two.
That's quite the metaphor right there. So, Keith, I want to talk about equities just for a minute. You've been very bullish on equities, even during the downturn. You've remained very bullish on them, but now you're kind of changing your opinion. And right now, you're feeling a little bit more positive about fixed income right now. Now, is that just rising interest rates, or are there other factors?
That's right, Frank. We've been, big bulls the last 2 years, and we recently downgraded our view of equities from attractive to neutral. And one of the main reasons for that is we've seen this sharp move in interest rates. The 10-year Treasury, as you mentioned earlier, is now at 2.8. That's over 1% higher than where we were just on March the 1st. And as a result of that, something we call the equity risk premium, which is a fancy word of saying the comparative value of equities relative to fixed income, has dwindled to the lowest level since 2010. And when we've seen that historically and test that out, the stock's outperformance, which tends to be much higher, moves down to about 3% on a 12-month basis. So what we're saying now is, even though we still think fixed income is somewhat underweight, we think there's more opportunity than before, and we think there's some relative opportunity, and these yields are now productive again.
So earlier this month, even before you came out with this call on equities overall, you actually downgraded small caps. It looks, pretty prescient right now. The Russell coming off a 5-day losing streak. During the pandemic, a lot of our guests called the small caps in general, but the Russell, kind of the reopening index. And for the most part, the country's, pretty much reopened. My hometown of Philly reinstating its indoor mask mandate. But overall, we're generally more open than we have been before. Why are small caps struggling?
Yeah, well, we were also bullish most of last year for small caps, but we did downgrade small caps more recently because of the economic cycle. I think as the Fed raises rates, as the economy starts to slow down somewhat, that will affect small caps. And the other thing we look at in our work, they are very cheap. So on a long-term basis, I still think they're attractive. But more tactically, we're seeing relative price trends weakening. And we're also showing the earnings momentum relative to large caps weaken as well. And that's led us to go ahead and downgrade our view. Again, small caps are very leveraged to the economic momentum. We don't think we're going into recession, but we do think we're going to have somewhat slower growth in the economy relative to what we saw over the last year or two.
All right. So no recession, but slower growth. You're downgrading equities. Where are you overweight at?
Well, it's more, I think it comes down to more where there's opportunities within sectors. So we've been overweight energy over the last year. We still like energy, even though it's in a bit of a digestion phase here. And we've become more positive on some of the defensive areas of the market over the last few months. So areas such as consumer staples is an overweight. We still continue to like REITs, which has a good dividend, and also it has some tech exposure and some reflation exposure as well. And some areas that are starting to look more interested, though we're not overweight yet, is things like healthcare and materials, which all are typically a bit more later cycle type of sectors.
And how do you see inflation kind of playing out? I want to kind of circle back to that CPI report because everybody's kind of looking ahead to that. How do you see CPI playing out for the sectors that you are overweight in? Doesn't inflation still impact energy, and doesn't it still impact even those REITs you were talking about, whether they're for cell towers or whatever else?
Yeah, no, that's right. But energy is more of a direct play on inflation staying somewhat elevated and oil prices staying somewhat supported as well. So we like energy. As you think about places like consumer staples, as an example, if you have a somewhat slower economy because the Fed's going to press higher with higher rates, that should be a good sector in a more kind of choppy market that we envision. And then with REITs, there's some positive aspects as far as like the cell towers. Every year they raise prices based on inflation trends. So we think there's some offsets, and also there's a nice healthy yield in the REIT index as well.